hello there.
Hey Daniel, how you
Hey,
doing?
Hey, Casey, how's it going? Glenn, good to see you. How you been?
Hello, sir. I've been well. How about you?
Oh, decent. Doing good. Let's see. It looks like I need to plug in my good microphone. Sure it's
You
going
definitely look
here.
like you've been losing weight.
I lost almost 40 pounds in the first 6 months, but I've gained about 20 of them back in the last two. So
Still net positive, still looking better.
yeah, I got to get back to the gym. I got off the habit and then went back to my old bagel eating, bagel loving habits and it came back quick.
Yes,
Those
I
will
hear
get
you.
you.
Yeah. Well, and it's not so much the bagel as all the butter I put on it. Oh, so good.
Lox, cream cheese, capers, butter, all good.
Oh,
Oh,
stop. My family's out there having lunch eating hamburgers right now. All right. We're gonna wait. I guess we're about 4 minutes early. Hello, Leo. Good to see you. Are you new to the group? Newer?
I am.
Good to meet you. Our
Pleasure.
group is a little smaller than it used to be. I think we had around 40 people last week. Um, and towards the beginning of the year, we were up at 70, 100, and 2, 3 years ago, we were often quite a bit more than that. So I'm going to ask everybody to spread the word of mouth. I tried the social media, putting it on social media and advertising, and I got like
Mhm.
zero uptake on that. It was actually really shocking. I would
Yeah.
put it out there in various channels and just like one person would show up.
Wow.
So I don't know what I was doing wrong there with social media. I probably need a 20-year-old to school me.
Right. We're all trying to figure that out. It seems too like though that the market's just gone through obviously a big cycle over the past couple of years, and so I'm assuming that some investors that got kind of burned on that are a little hiding out right now.
Yeah, I think that is some of it. And some of it is that Intel is not doing so well. Um, but anyway,
need an intern, Daniel.
I do really badly. I have the club leadership board. They're supposed to be my interns. No, no, they're supposed to help me with finding speakers, and I would love it if somebody would help me with social media. Um, but because I don't enjoy social media.
Yeah,
I'm a
but I mean,
curmudgeon.
if you think about it though, Daniel, right? If you think historically over the what's it been, 4 years, five almost?
7
Okay, for
in
me, I
September.
guess.
Yeah, 7 in September. I've been doing this almost every Friday.
The organic nature of the club size expansion and contraction, uh, and I think how it's done it, I think has been independent of the social media elements to it.
Well, yeah, I mean, while we were internal to Intel, there was no social media element, and I mean, I guess there was the Inside Blue Intel internal pages.
Yeah, but I think it was a lot more word of mouth or
Yeah, I think everything has been word of mouth.
some elements of the employee resource group infrastructure, Inside Blue, et cetera, whatever. But even the Facebook, Walmart, Apple, uh,
All those
groupings
other
that got
clubs that I
that
started helped start.
that yeah, that got together, right? All that stuff, I think even all of that was, a lot more organically developed. Um,
Ashish, good to see you.
Hey, guys.
Sorry, Glenn, I didn't
yeah,
mean to cut you off.
no, it's okay. It seems to me like, you know, the method, right, of finding new subscribers and the content targeted for it, um, I think are highly correlated.
Yeah. Well, in any case, it's my goal here to try to learn something new from each speaker every Friday and just to grow in my own investing experience. And I want everybody in the group to come along with me on that journey. So that's kind of the goal. And I see a number of the regulars here. Hi, Brian. Hi, Sean, Peter, Cynthia, Craig, Mark, JM. Recognize the names coming in. Welcome, everybody. So we're starting here. We're going to wait just, 3 or 4 minutes and let us hit a critical mass. And then we will kick it off with so maybe I should have put this out in the email that I sent out, but it is rare after 7 years of doing this almost every Friday that I find a truly novel real estate strategy. And we have that here today. Something that when Casey and I were talking, I had to sit back and think about it and go, that's really cool. And so I'm really glad that he's coming in here today. Hello, Bob, Alex, Gene, good to see you. I still have the key to your office. I need to get that back to you.
Anytime.
Okay. My wife comments on it about every other week that it's still sitting on our key rack.
We got to grab lunch sooner than later.
Okay. Good to see you all. Manju, Alex. And if I didn't mention your name, why don't you introduce yourself here? We'll kick this off with a little bit of interactivity. Can you just put into the chat where you're from? I know it changes over time. I think that Folsom, California is still the place where we get the most people, but you tell me, where are you coming from? Glenn's from Chandler. Let's see if we can beat Folsom here. Oregon, Ashish, I know you. Anita, San Jose, Folsom. We've got Folsom representing. Good job, Chris. Beaverton, Salt Lake. That's a fairly new one. I don't think I've seen too many Salt Lakes before. Welcome. Uh-oh, DC. Leo. Are you at an Intel office or did you find us organically? I'm curious.
By accident.
All right. Oh, by accident. Oh, well, welcome. Welcome. Accidents can be good things too. All right. Well, we've got 35 people, 36 here, so we'll start to kick it off. And we are recording, so that's good. But I will put a little clap here in the soundtrack just to let the editor know, which is me. Welcome to the Alternative Investing Club, everybody. Today is August 1st, 2025, and we have a great topic for you. In fact, it's fairly rare after 7 years of doing this almost every Friday that I find a new topic that I never heard about. Today, we're going to learn how to save a ton in taxes when doing your IRA conversions and a whole lot more. So everybody, if you're just coming in here, put in the chat where you're from. I see Folsom is representing fairly strong, but Portland might be overtaking now. I'll have to keep an eye on it. Welcome, everybody, from wherever you are. Today, I want to introduce Casey Stratton. And Casey, why don't you come on here? Let us know who you are, where you're from, and what type of business you're involved in, and what are you going to talk to us today?
Absolutely. First of all, thanks for having me. I love coming out and talking to investors about what we're doing here. Today we're going to be covering this IRA conversion strategy, which we're about 90% through our feasibility and due diligence. Obviously, we've been partnering with a number of professionals, tax attorneys, CPAs to really flush out and make sure we're covering every corner here before we formally launch this offering. And I will say real quick, Daniel asked me to fill in for a speaker that backed out. I'm actually on a family vacation right now, so I'm holed up in a bedroom. So apologies if I have any audio or video issues here, but didn't want to miss the opportunity to meet and talk with the group. So I can put my slides up if you let me share that.
Yeah, go ahead.
Okay. And again, I'm just off a laptop. I'm running my dual monitors here so I can be a little more looking at things. How's this coming in?
Looks good. There you go. Perfect.
Okay. Wonderful. So I'm the founder and managing member of Tamarack Capital. We are a alternative real estate platform for our investors. We want to bring in real estate opportunities to them. We do value add multifamily development. We have a income fund, which is more debt investment. But this is our latest and greatest product that we're bringing out. And this is actually, I'm excited. This is the first larger investor group that I'm sharing this concept with. So very interested to get feedback on what you guys think. And yeah. So before we get into it, the standard disclaimer, this is not tax advice. It's more tax information that you'd want to bounce off your professionals. There's no current offering right here. We're just having fun talking about some strategies that are well known, but we're packaging them together in strategic ways to really amplify some tax savings benefits.
Hey, Casey, can I give my disclaimer too?
Yes, sir.
Basically, ditto for us. We're a platform of education for investors, by investors. And Casey, I also wanted to let you know that normally what we do is people put their questions in the chat, and I just mark them off. And then at the appropriate time, I'll judiciously interrupt you, or we can save them all to the end, depending on your preference.
No, thanks for bringing that up.
But I'll act as a moderator, and so you don't need to look at the questions. You can concentrate on your talk.
Thank you, Daniel. With that, guys, we're taking a few concepts and we're building on them. So I think it's pretty critical to have a good understanding before we move on. So with that, if there are any questions, Daniel, let's hit on those while they're fresh in the minds and get those knocked out.
Sounds good.
So at Tamarack, I'm going to go a bit into my background and how I got into raising capital and putting together real estate offerings. But we firmly believe that anyone who is trying to improve their financial health and reach their investment goals should have real estate as part of their portfolio allocation, a part of their investment strategy. We also think that getting into more commercial grade properties is pretty critical because you have a lot more control over risks and strategy. And that's just really not feasible for working professionals to go in and have the time and or experience and network to put these together. So this is where we're excited to come in and put these offerings together. And the other pillar that we have on this is risk mitigation. I think that anyone who's been aware of what's been going on over the past 5 years saw this huge run up in the bubble. And I even had involvement on deals and partners who wanted to try and juice up returns as much as possible. They're like, we got to sell 25% internal rate of return, 30% returns. And to do that, one, you got to be, I think, overly aggressive on your underwriting assumptions and also juice up returns with, I think, unresponsible levels of debt. So what we do is we try and bring responsible offerings that control risk. Our goals here are to hit doubles, not try and swing for the fence. And as part of that, investors, if you're trying to get those 30% IRRs, we're probably not the guys to be working with. We like to just get on base and make sure that we're controlling for the downside. So going on to our team, I don't want to go into this too much, but we have a great leadership team. My partner, Max Schneider, has 16 years in operational expertise. He's a guru on asset management. He runs all of our value add projects. Tori Azure is our newest member. We just brought him on actually last month. I've worked with Tori. I was on the board of his branding and digital marketing company for the past 8 years. And we ended up selling that business. And before getting into marketing, he's kind of this weird guy who's both an engineer and creative. He did 12 years in land development, and he wanted to get back into the real estate industry while also leveraging his genius in marketing. So super excited to have him. Everything that looks pretty is because of him. And he's also helping us launch a lot of new initiatives that I'll wrap up with. We have our investor club that we just launched, which is really just foundationally a mailing list and keep up to speed on what we're doing. We just launched a podcast. So we'll hit on at the end, but that's all due to the capabilities that Tori brings in. Myself, I've been in real estate for, since the last Great Recession. My story of how I got here is I studied engineering in undergrad, went to the University of Washington to get my MBA in finance. I was the youngest person in my class of 100 and graduated, got a great tech job, was feeling really good. And then the Great Recession hit, and not even 2 years into my job, I got laid off. And trying to find a new job, it was month after month after month. It took me 6 months to get back into a job that fit my skill set. And 6 months when you're 26 years old, it was pretty devastating. I took a big ego hit. I was really down on myself. And when I did start the next position, I really wanted to make sure that I wasn't back in that position, still reliant both financially and emotionally on an employer. And that led me to the FIRE movement, which I'm sure many of you are familiar with, the financial independence, retire early. But it's pretty much the concept where cut your spending, save, invest. It works well for high income earners, and build up an asset base that you can create passive income on. And of course, you know, I was a finance geek, so I'm researching every investment strategy out there, trying to supercharge things. That brought me to real estate. My wife was pregnant with our first son, and I convinced her to sell our house that was nice and had a lot of equity, so we could take that equity and go buy 2 duplexes. And so we moved when she was all big and pregnant, and my first son was born in that duplex. We did quite well on that. This was during the 2015 to 2019 period, and so we saw some good appreciation. Kept investing in real estate, started getting commercial assets. And during this time, I was a CFO of both a tech software company and then my partner's law firm. And we, 2020, February 2020, I decided that I want to start raising capital and investing in real estate full time. I just loved it so much. Gave my 2 weeks, well, not 2 weeks notice, I gave him as much time as he needed, but said I was leaving in February 2020. We all know what happened in March. And so I stayed on to kind of help them transition the COVID lockdowns. But then launched into my capital raising career with everyone in lockdown isolation. The stock market had crashed. Nobody wanted to do anything crazy. So it was a pretty crazy time, but we've grown out of that. Since then, I've been a general partner on nearly 200 million in deals. And, you know, I think that what we're talking about here today, the IRA conversion strategy, is pairing my passion for real estate investing with my curiosity into taxes and how to optimize every aspect of that investment. And real quick, kind of hit on this already. At Tamarack, we have a portfolio of offerings, whether you want invest in the income fund, which is like lower risk and more predictable income. We can only see about 9 to 12% annual cash flow, all the way up to we do development and value add. Today, we're looking at the IRA Conversion Fund. And so we're going to start off by going into some really foundational principles here. I'm sure this is just basic 101 that everyone already knows, but just to establish we're all on the same page. IRAs are tax advantaged investment vehicles where on a traditional IRA, you don't pay tax on the contributions you make to it. So let's say you're maxing out for the year and it's say $20,000. You're not paying income tax on that $20,000. It goes into your IRA, you invest it, it grows tax free, but then when you pull that money out, that is taxed as ordinary income. Likewise, the Roth IRA, you are contributing to it with money that's already been taxed. It grows in there, and then when all of that growth and contributions, you pull it out, you don't pay any tax on it. I think, I guess, are there any questions on that? Cool. So many people also know, but surprising people don't know, that at any time you can roll over a traditional IRA to a Roth IRA. And when you do that, you pay income tax on, you pay income tax on the amount that you roll over. And that is taxed on the fair market value of the amount that you converted, right? So what is fair market value and how is that different from net asset value? A lot of times these are the same, but their definitions are different. So a net asset value is basically just an asset's value subtracting out the liabilities, or essentially the equity in the investment. So if you have $1 million property, you have 700,000 in debt, your net asset value is 300,000. Fair market value is what the asset would sell for under conditions where there's an informed buyer and seller both trying to get the best possible price point. If we apply this to a very basic example, if someone has an IRA with $100,000 invested into the S&P 500 and they roll that over, the $100,000 is what is going to be the income that's going to have that tax liability. And this is simple to understand because there's a very well-established liquid market that says if you have this many shares at this price point, it's valued at $100,000, right? But if we go to a private investment, we have to ask ourselves, what's the fair market value of a private investment? So if an IRA owner invests $100,000 into a syndication, the net asset value is $100,000, but what is the fair market value? And at first you might say $100,000, but in reality, let me ask you guys this thought experiment. If I were to come in and say, hey, Daniel, I'm going to give you $100,000, would you rather have it in straight up cash, or would you rather have $100,000 of ownership in this syndication that you have no control over and it's not liquid? How would you feel about that?
Cash is king.
Cash is king. So it's well established that fair market value is generally lower than the net asset value for private investments like syndications. And it's because of things called discount factors. So what is the discount factor? These are the things that an appraiser are going to use to modify a net asset value to a fair market value. And there's three ones that are really core to understand here. The lack of liquidity. So we know that real estate's really not a liquid investment, right? You put your money in. To sell that asset, you're going to have to pay brokers, excise tax. It's going to take a while. Obviously, you're not going to get that cash back, and you're not going to get all your net asset value back. The second is lack of marketability. If you invest into a partnership or a syndication that owns that real estate, there's no ready market for you to go and sell off your interest in that business, right? You're kind of stuck in, and they have to understand it. You're going to ride through the investment life cycle. And then the third is lack of control. As a limited partner, you really have no say in timing of a cash out refinance or a sale. You're relying on the sponsors to make these decisions. All of these are factors that are going to reduce the fair market value of that investment. And I guess I'll say the reason people still invest in syndications is that given their understanding of these risk factors, they're willing to invest money in to ride through that, say, 5-year investment life cycle. But yeah, these really apply to real estate syndications. They also apply to other private investments. So with to understand, if you invest into a private investment, you can't just go in and say, okay, well, I'm going to discount it down, right? Because you're not knowledgeable and you're conflicted. So you want to have a third-party business appraiser go through and evaluate what the fair market value is. This can range a bit depending on multiple factors, but we're typically seeing about a 30% discount factor, which means that if you invest $100,000, the fair market value would be roughly $70,000, right? And I think it's funny to look at the flip side of this, right? The IRS, it's very clear in the Internal Revenue Code that this is how you value these things. And the IRS even enforces this when the shoe's on the other foot. When individuals make charitable donations, I want to get a tax deduction on that. The IRS says, no, you might have a net asset value of 100, but the fair market value is down here. You can only take the deduction for that fair market value amount. So it's very well established. The IRS fully understands it. But these are the principles the first principle that really helps understand how we can make a tax efficient conversion. So if we apply this to $100,000 invested in a real estate syndication, fair market value has been appraised to be $70,000. And this reduces your tax liability from 40 or 30%. So if you were paying a 40% federal and state income tax rate, you'd reduce that down to 30% to be 28%. And the whole name of the game here is when can you get your money from an IRA either distributed out or to a Roth at the lowest tax rate possible, right? So this is nice. 28 is decent, but I don't think that in and of itself is motivating enough to incentivize certain investment strategies. So this is where we bring in the second pillar of this strategy, which is leverage. So again, this goal here is to reduce the tax liability as much as possible to zero. And it's important to understand too that IRAs are perfectly able to borrow money. Generally, people who use self-directed IRAs will invest into a offering that already has leverage at the property level, right? Generally, do an acquisition, you have a loan on the property. But IRAs can also borrow money. So under this model, we're assuming $100,000 in cash in an IRA that then borrows an additional $200,000, and we're seeing a 30% discount factor. So if we look through the steps here, we start off with a net asset value of $100,000 straight up cash. The IRA borrows an additional $200,000, So now they have 300,000 in deployable capital. They invest that into a offering, privately held investment, and a year or two later, they get an appraisal done that gives a fair market value of $210,000 or a 30% discount. When that conversion happens, we take the fair market value of 210,000 and we have to subtract off the liabilities there. So the net value of the rollover is going to be $210,000 minus the $200,000 in debt, or $10,000. And you can see we just try and use round numbers illustratively. You could tweak up the leverage a bit and try to get that down lower. Maybe you want to be a little bit more conservative, you don't mind paying some income tax. These are variables we can play with, but this illustrates the foundational principles. So I'd like to pause here and just see if there's any questions, Daniel.
Yes, let me pull up the chat to see if there are any questions. If you have any, go ahead and put them in the chat. Ashish is asking, does this strategy primarily work on new construction?
It will work on any privately held investment where you have leverage, right? You're asking about what's the investment strategy, and I'm going to get into that in a few slides, but I have some opinions on what the right investment strategy is to achieve goals of fairly good returns while mitigating risk, because you don't want to invest in something with a good tax strategy, but have that investment crash out and your investment go to zero, right? And so I think that development is an option, but in my opinion, it's a bit too much of a risky asset class to try and pair with this.
Okay. Now we've got a couple of questions rolling in here, and Rob was
Perfect. Love
actually
it.
first. What?
Oh, I love it. Love it.
All right. Rob says, for the purposes of this discussion, can a 401k be considered the same as an IRA?
That is a great question. Typically, no. 401ks are held with the employer's custodian, and they are generally not something that you can take out and invest in alternative assets with. There is conversations inside the current administration about amending the 401k tax code to require employers to allow employees to self-direct the 401k as well. So there could be some changes that could allow that, but right now, no.
All right. Robob is asking, what happens when you sell the investment and cash out? And maybe you're going to get into that a little bit more. I'm not sure. But if there's anything that you think you'll be answered later on, we can go ahead and hold those questions.
No, let's hit on that right now. So we kind of talked about this multiple step way to get the fair market value down to 10,000 at conversion. Now that's year two of a 4 or 5 year investment life cycle, right? So you pay income tax on 10,000 of taxable income, but then you hold it through the life cycle. And let's say that the property then sells in year 4 or 5 for a 2x gross equity multiplier. You would get back, so you invested 300,000 total, you would get $600,000 back, right? You'd pay off a $200,000 loan, and then you'd have $400,000 in cash in your self-directed account. So you took 100,000, you end up with 400,000 at the end, but during that period, because of the strategy, you pay $10,000 to roll that over, and now you have $400,000 that you never pay tax on growth or distributions.
All right, and good follow-up question to that is actually Glenn's. Who's providing the loan? Is the interest deductible, or is this one of those borrow from yourself, be your own bank strategies?
Yes. Okay. I hit on this a bit now or later, but this is a really interesting thing. So one of the questions that I get down to is, okay, all of these principles are well established in the Internal Revenue Code. Why isn't this more prevalent out there? There's a couple reasons, but one of them is the IRA loan is a bit of a challenge. IRA lenders, it's a small niche and immature market, and they solely focus on, if you have $100,000 in your IRA and you want to go buy a duplex, they'll lend you the additional amount, but that loan obviously follows all the debt service coverage ratio covenants, LTV covenants, and that money, that loan is secured on title of the property, right? IRA lenders are not just going to give you unsecured loans that you then invest into a syndication business, right? They want to be on title. So as part of this, and this is what we've spent the past year on during our feasibility, is actually developing our own IRA lending partnerships that help us out. Part of that is if you're going to be making $100,000 investment in here, you're going to need to have $250,000 in your IRA, part to fund this loan program, and part also to make sure that you're secure your debt service reserves. So if you have, say, a $500,000 IRA, you're probably going to do multiple investments over a decade to safely convert your IRA through it.
Okay. Gene is asking, oh, I'm sorry, Glenn has another question here. Is the 100K IRA conversion leading back to a 90K Roth result? And
I think he's asking, like,
you,
what's your cash at the end of the investment?
yes.
Yeah, so that $10,000 is purely a value on a paper form, a 1099-R, when you do that conversion. That's just the reported third-party appraised value of what you're converting over. It has nothing to do with, I mean, it could be zero, right? But you still end up in the scenario where you put $100,000 in initially and end up with $400,000 at the end.
Okay. Gene, who is a new construction builder in our community here, is asking, can the loan be recourse, or does it have to be non-recourse, which are very difficult to obtain?
Yes, so IRA loans, by definition, have to be non-recourse, or else they invalidate the IRA because you're using non-IRA assets to collateralize risk inside the IRA.
Okay. And he follows up with, who's the lender to the IRA? And I think you've already mentioned that you've built up your relationships.
It's other offerings we have. We built up the entire ecosystem.
Yeah. Okay.
Which has been, frankly, one of the biggest challenges out there, is how do you make sure that, debt interest rates are commensurate with the amount of risk? And if you have unsecured, non-guaranteed risks in there, how do you make sure that you don't have an insane interest rate premium? And that's part of the secret sauce that we put together.
All right. Thornton is asking, what about rolling over 401ks? And I know we already touched on this, but I'm going to read his question as it is. What about rolling over 401k funds to an IRA after separating from your company? Could the strategy be employed in that case?
100%. Yep. That's no problem at all.
All right.
It's just an additional step. You go from the 401k to the IRA to the self-directed IRA custodian to us. So.
All right. Hey, a shout out to Dennis. Thank you for helping me mark the questions with the little emoticons in the chat. That really helps. Anita's asking, what happens if you can't get a reduced future market value appraisal?
Right. Well, so this is what happens is you get the appraisal first, and then you make the decision on the rollover. So we're not recreating anything different, really, offering to offering, except for what the underlying asset is. Whether it's apartment A, B, or C, they all fit the same profile. So there shouldn't be overly much variation in the discounts, but you're not forced into a conversion if you don't want to be. I see that as a more minor risk on that.
Brooke is asking here about your phrase, subtract 200K debt. Are you paying back the loan before rolling over the Roth?
Oh, great question. No. You're purely trying to determine the equity, if you will, of what you're rolling over. So it's fair market value, if you look at that graph, 210. But if you roll over that entire 210, like, you're not going to pay income tax on a debt liability you hold, right? So you got to kind of just pull that off the books. You're not actually paying it off at that point.
Getting lots of questions in here, which is great. I love this community.
This is excellent.
All right. So, and apologies if I get your name pronunciation wrong here, but Elaine or Alan, is asking about what about the pro rata rule if you're only converting part of your IRA?
So that, from my understanding, and we work with Madison Trust, who is one of the premier custodians. The assumption that I've been operating under of how we'd set this up is that you would have a self-directed IRA account, and you'd fund that completely with what you want to roll over. So you're rolling over the account. If you go in and you have, say, an IRA account with $100,000 invested, so that borrow 200 invested with us, and you have some other, say, S&P 500 in there, I am actually not sure about separating that out for the rollover. I've always been working on the entire account rolling over, so I can look into that and get back to you.
All right, Glenn is asking. He's got a rephrasing of his prior question, and he's got a little more in here now. So rephrasing my prior question, assuming there's no gain on the investment, a 100K IRA borrows, quote unquote, from itself 200K more, and some number of years later appraises to 210K. Then subtract the debt. 10K liability remains for whatever percentage margin. So my 100K traditional IRA is now 100K Roth minus the 10K tax rate, or times the tax rate. I think he's asking if he's got this process straight in his head, basically.
Yeah, so if we assume no gain on the investment, just to make it real simple, 100K in your IRA, it borrows 200. You roll over a fair market value of 210, but 200, that's debt. So on your 1099-R form, you're going to have an income tax liability of 10,000 of income. So maybe you pay a few $1,000s paying your tax rate. Now the life cycle, the investment goes through its life cycle, and then you're exited when the property sells, and now you have $100,000 coming back in. So when you're done, you start with 100, you end with 100, but now you're in a Roth rather than an IRA. So Glenn, does that answer your question?
He'll let us know in the chat in a moment. Manju is asking, what are the tax implications for UDFI and UBIT?
Absolutely. So UBIT is something that would happen in there if we were under
And
Glenn's.
maybe you should explain those for people who don't know what they are too.
Sure. So UBIT is unrelated business income tax, and it is a condition that happens when IRAs use leverage. And this applies whether you're investing in a normal syndication where there's leverage at the property level, or your IRA borrows money. But pretty much it's saying the IRS doesn't want you to jack up the risk on an investment and try and like swing for the fence and then have a bunch of gains on it. They're saying if you leverage, let's, in this example, 2 to 1, so you're 66% leveraged, and you have, let's say that for simple math, that that investment doubles your money. The portion of that attributed to leverage will then actually be income tax that the IRA needs to pay. And so this is really just something that we build into our calculators and say, yes, there's going to be gains later on. You're going to pay some income tax on that, but that's just part of the cost of doing business any way that you invest in real estate with your IRA.
We're getting more questions in here, so and some more creative questions as well. Ajay is asking, so how does borrowing? Let's see, how borrowing 200K and its interest. How are you borrowing the 200K and how will the interest be paid? Yeah.
Yep. So you're borrowing it from our lending portfolio. So I don't. If there's more specific questions in there, I'm happy to help on that. There is going to be current interest only on that. There's no amortization, but we do want to have the IRA make sure that it funds a portion in cash that is just set aside for interest reserves. And this is kind of cutting ahead to the investment strategy. We want to be investing in more stabilized assets and high growth markets because we want to have that property throwing off current income to help service that debt. So let's just say we're buying in at a 6 cap and the interest on the debt is 8%, right? in an idealized world, you're getting 6% cash distributions from that investment, and your interest costs you 8%. Okay. But you're also only paying interest on 200,000, whereas you're getting a cap rate on the full 300,000 because you have an equity portion in there. So that should fully cover the debt service on that loan.
All right, one more question, and then I want to make a comment. But we have another
Sure.
question from Glenn. Glenn's got his thinking cap on here. Can you employ offshore blockers as a counter to UBIT?
Oh.
You might not be the expert in that strategy, but
Glenn, we need to talk. That's a new one. I haven't heard of that.
I've heard the strategy around before, and oftentimes it's punted as to whether you could do things like that over to the CPA or the lawyer.
Yeah.
But I've heard that strategy before. Hey, I wanted to emphasize again, actually, Thornton's original question about if you've left your employer and you have a 401k, can it be rolled over using this? And just to put it into context, this group started at Intel. Intel has been going through downsizing. There's a lot of people that are in that situation. And I wanted to give you the opportunity maybe to go back and specifically address those people and talk through the situation from that point of view, perhaps a little bit more, or just to comment on it to help people understand how it applies and if it applies to their particular situation.
Absolutely. Yeah. I went through this personally when I went through my reduction and got laid off. I had money in my employer's 401k, which they're semantically the exact same, a 401k and an IRA from a tax perspective. But they're different parts of the tax code, and the 401k is held specifically with tied to the employer. And the employer gets to dictate what type of investment options you have. If you've ever set up a 401k plan, which I've done, you go in and you say, okay, we want to have these 10 options, right? We want to have some S&P 500. We want to have a Vanguard International Index. We want to have some high growth. We want some bonds, maybe some target date, whatever, right? Those are your only options. When you leave that employer, you can leave your money in that 401k, or you can just go and fill out a simple form and say, convert it to an IRA. It's a paperwork change, but now your account says IRA, and it's no longer tied to your employer. And your investment options are everything that lies within that IRA custodian. So if you're with Fidelity or Vanguard, you can invest in everything that they offer, right? You also have the option of saying, hey, Vanguard, cool, I want to go with a different custodian like Madison Trust. They wire the money over to your Madison Trust self-directed account, and then you can do alternative investing like real estate syndications, a bunch of other things. Think that adequately answered that, Daniel?
Yeah. Sorry, I had my son speaking to me on the side.
Sure.
Yeah. No, I think that Gene's comment here kind of sums up a lot of the situation as well. You should roll over your 401k into a self-directed, or you should make sure that while you're in between jobs, you're thinking about transitions like these.
I would completely agree with that. Let me hit a few of the other slides, and then we can get to the final Q&A.
Let's do it.
Cool. Guys, great questions. I'm floored. This is great. So, okay, we've already beat this to death. You go from a net asset value of 100,000 to a fair market value of 10,000, and now you have your whole investment in a Roth. It's a great opportunity. So, what this looks like, if I'm assuming your group, Daniel's pretty familiar with syndications.
Oh yeah.
Perfect. Okay. It is just like a normal syndication with two big changes. One, like we already talked about, the debt is held at the actual investor level, the IRA investor, not in the investment offering LLC. This is unique. One, because you don't want to have leverage upon leverage, right? We talked about risk mitigation, that's risk amplifying. So if you're holding debt up in your IRA, you want to be investing into a all cash or near all cash offering. Maybe there's circumstances where you want 25% debt on the underlying LLC, but the majority of the debt's held the IRA. So this is again, we go to why isn't this more prevalent? This is a bit of a challenge here because that means that you cannot commingle IRA conversion investors with traditional investors. And likewise, you can't have a traditional syndication where you want to bring in an IRA conversion investor, right? Because either you're doubling up leverage or you have an investor, a traditional investor who now is investing into a unlevered asset, which really hurts returns and doesn't make a lot of sense, right? Secondly, we are having an investment thesis here of not trying to amplify returns with like a value add strategy, but more trying to go into a more stabilized asset in a high growth market. And the primary reason for that is that value add investments generally have a 2-year period of restabilization where you're turning units, you have higher vacancy, and there isn't any current income to go back and service that debt for the IRA loans. This strategy also leads almost into like a blue ocean strategy where you can imagine us as a sponsors, we will, phase one for us is to get our IRA investors who are all interested, get them set up with the custodians, with the loans, and then we fund it into the offering LLC. We're now going and trying to acquire properties with all cash and the cash is in the bank. So if you've ever tried to bid on properties and try and win over an acquisition, showing them a bank statement with all the money needed to close is like a golden ticket to negotiate your butt off and get the best deal possible because they know you're going to close, right? We're also going after stabilized assets, which don't have the same competitive bidding as all the syndicators want all the meat on the bone on the value add, right? So we're going after different assets with an all cash strategy that makes us get very good deals for the investors. So this is what's got me really, really, really excited about that. So I think I hit on this. Yeah, stabilized Class A, Class B, high growth markets, minimal property level debt. With that, our target IRR, we're going to have, in high growth markets, we're looking for good rent growth, IRRs around 10 to 15%. Because we're not doing a value add and then stabilization period, we have a bit more flexibility where we could be rotating, and selling these assets a bit sooner, like in the 4-year mark. We also have the opportunity where our goal is to be doing staggered IRA funds. And so after year 4, maybe we have a new fund that could benefit from this exact same asset, and we can liquidate that asset to the new fund and do so with extremely low transaction costs, further saving our investors money. I think we kind of hit on this. So what are the risks or downsides? Everything we talked about today is well established in the Internal Revenue Code. If there was an audit, the only thing the IRS could push back on is the discount rate. And that's why we use third-party appraisers, and we get very robust documentation and appraisals for why we have this. This investment strategy does not rely on trying to game the system or maximize the discount, right? We can do just fine with very fair, conservative market rate assumptions. This is not a good strategy for those who don't want to invest in real estate syndications. This is where we spend a lot of time. It requires numerous strategic partners. We have appraisers who understand what we're trying to do here. There's a 2-stage appraisal process where one will get either an appraisal or a broker's price opinion on the underlying asset. And then we have a business appraiser who actually evaluates the deviation of fair market value, the discount from net asset value. But that appraiser, the business appraiser, needs the property level appraisal. We have IRA custodians that I've worked with for years. They understand what we're doing here. I'm in conversations. I've talked with their valuation teams, and they fully understand it. The big one is the IRA lenders. This is going to be a multi-partner strategy of having a fund with outside lenders coming in, as well as IRAs lending into our funds as well. And really, I think lending to an IRA under the strategy is one of the biggest technical challenges of trying to facilitate the loans. And then the last one is we're doing something that's pretty unique in that we're going to go in with all cash unlevered real estate acquisitions. And, you need experienced general partners who've been doing this for a long time, who have the network and the team and an understanding of how to put all this together. I think I've seen since the pandemic, there's been a lot of new entrants of operators coming in who were attracted to quick, fast money and the market always going up. And how do we, leverage and look sexy and all this stuff? And I'm quite thankful that the market's weeded those out. We're still here because we don't try and buy into the hype or push things in a way that's irresponsible. So with that, next steps for us, the technical feasibility is completed. We're still finalizing a few things on the strategic partnership front. We're pre-conditioning investors out there with what we're doing. Like I said, you guys are one of the first groups I've talked to, and I'd like to see us launch our first offering in late Q4. So with that, let's open up to more questions. I got some QR codes here. If you guys want to book a call with me, well, first of all, you can just go to our website, tamarack.rei.com, or you can use these QR codes to book a call. If you just want to stay up to speed on what we're doing, we have the Collective Investor Club, and that's mainly our newsletter and first look at any deals we're bringing to the market. We also do some events here and there. Sounds like we got a pretty diverse geographic location, so it might be hard to get together in person with y'all, but join the club if you want to stay up to speed. And then we did launch our podcast called Directly Invested. I don't have a link on that, but if you go into any Apple or Spotify and just search that, will pop up. So yeah, with that, let's hit on any other questions.
All right, great. Thanks for sharing all those. We've got, I think, only one question currently because we went through so many before. William's asking, is this strategy targeted towards retired individuals or people that are more like 15 years from retirement? So is this strategy for people who are currently looking to retire? I guess would be how I would say that.
So it has unique advantages to people in all stages of their career. I think someone who's in their 30s or 40s is extremely advantageous because they can get all of those savings, all that investment in their IRA into a Roth IRA with minimal taxes. And then all that's going to grow for another couple of decades tax-free. That's a huge advantage. But additionally, people nearing retirement, if you've done well and saved and invested consistently, you're going to be hitting the required minimum distributions at 70 years old. And by doing this strategy, you can minimize or eliminate those RMDs. And so we got different tools. Like it's the same tool to different problems.
Okay. And I will have to say, I'm having a little trouble locating your podcast. I'm going to find it here, but is it Directly Invested Podcast or just Directly Invested?
Just Directly Invested.
Okay. All right. We've got more questions rolling in now. Glenn is asking, so this fund and structure is still in development and not yet released, correct? Also, is this an open or a closed-ended fund strategy?
Yeah. So it'd be closed-ended, and fund might be a misnomer. I think Tori kind of ran with that as I used it a little flippantly. It's not a fund in the sense that it's not going to have multiple real estate offerings underneath it. It's going to be more of a syndication model with one group of investors, one asset, one life cycle.
Okay. All right. I think that's all. We had another question there, but here it's back. She's just asking, how many deals do you vet before selecting an option to invest in?
That is a great question. So I can say on the syndication front, where we do the value add strategy, we're screening probably 100 deals quick to find 15 that fit our buy box market strategy. I mean, we're already in the right market and strategy, but 15 we want to dig into quite a bit. And then we put in about 5 offers to get one deal. That's our typical funnel. With this, I suspect that we'd probably have a quicker uptake, fewer deals we got to weed out just because we're going for less complicated deals, which already stabilized. And so there's less underwriting things to get caught up on.
Okay. Thornton is asking, does the target investment need to be real estate or can it be any public or private equity?
Can't be public equity.
Yeah.
Private investments, yeah, I mean, theoretically, this should work very well on
You need to be able to leverage it, right? That's the key attribute.
You need to be able to leverage at the IRA level, right?
Right.
You could, okay, let's talk about like a laundromat, right? And you're a limited partner in a laundromat, that theoretically should work. Would certainly have different discount factors. It just goes into the risk profile of what you want the underlying investment profile to be.
And with the strategy, you wouldn't necessarily, a lot of times people that invest in real estate are looking for assets that, have, a decent amount of depreciation. They might go into mobile home parks, but you're not looking for that here because that depreciation through, is affected by the SDRA.
Yeah, the IRAs, I mean, the depreciation just gets suspended because you can't pass it anywhere. So.
Okay. Let's see. Trying to go in order here. Ashish, how many deals? Oh, no, we already did that one. Glenn, how many assets have you already closed on using this IRA conversion system? I think you mentioned it's coming out. You're doing the first one, right?
Pre-launch. Yeah, this is pre-launch.
Okay. All right. Ashish is asking, do you have any institutional investors and are financials audited independently?
So no, we focus exclusively on retail investors. Going back to our mission, I get the most passion when I'm talking with people about their financial goals and if we have an offering that helps them out. And I was really excited to talk with this group because I've been hit by a layoff. I know that the tech sector right now and until like everyone's going through change, and having robust investment strategies helps buffer some of that change. And institutions, we might do that down the road, but right now it's not part of our core. Was there a second part to that question? Oh, audited financials.
Independently audited.
The costs of doing that on syndications that are 10, 15 million killed investor returns. When you start getting into more complicated things like closed or especially open-ended funds, having audited financials makes a lot more sense because there's more opportunity to get in trouble with gamification or emitted data. But no, we don't go through the cost of that on syndications.
It's quite pricey, and unless your fund or deal is of a certain size, it just doesn't make sense.
Yeah.
Okay. Shout out to Chris. He found your podcast on the Apple Podcast site and put a link in the chat. So if you
thanks,
want to
Chris.
if you want to find it, thank Chris. Let's see here. SG is asking, so the conversion to Roth IRA happens once the property is sold. Happens once the property is sold in 4 or 5 years. What if the
Can you repeat that
property?
question?
Yeah. So the conversion to Roth IRA happens once the property is sold in 4 or 5 years? Question mark.
No.
What if the property sells for less than what is paid? Yeah, I think we've got a misunderstanding here.
Yeah. So the rollover happens during the hold period. I would recommend doing it in the first year or two before you start seeing continued appreciation, because then your fair market value is going to increase. If the property is sold for a loss, well, one, we definitely did something wrong. Let's take this current market conditions as an example. We've seen that peak 2021, 2022 pricing has come down about 30% because of higher cost of capital, right? If we were for some reason in a similar market dynamic where valuations are down, we would simply hold. We're not pushed by having commercial debt with balloon dates on it to force us into a decision. So I would say at that point, we just assess what market dynamics are causing prices to drop. And if it's worth writing those out, we hold all the cards on options of doing that.
All right. We've got some people that are asking more about specifics of a particular deal, like minimum investment, what's your fee schedule. I think I'm going to hold those since you mentioned your deal isn't out until Q4.
Yep.
Yeah. So, but Glenn is asking about the geography. Do you have a particular location or area that you tend to focus on?
So right now, so we're up in Washington State. We focus on Eastern Washington. We're seeing a lot of positive economic and demographic changes in our core markets. We're actually out of Tri-Cities, Washington, which is, I think it's on the top 15 fastest growing MSAs in the country. We have a large logistical and hub between the Columbia River, Snake River. We have interstates, we have rail lines. We have cheap hydroelectric power, and we have a very educated workforce. So all of this is drawing in major employers. We're seeing we have a $3 billion nuclear research plant campus coming out. AI and data centers are being built because of our cheap land and hydroelectric. So we like our market. We're also looking at Salt Lake City. I was actually on a call this morning with some brokers. We're looking at some market data there, just to make sure that we can find the right amount of deal flow and the right conditions.
All right. Glenn says go Huskies.
Yeah, I saw that diploma back there, Glenn.
And this might be our last question here, but also, feel free to put any closing remarks in you want as well.
Yeah.
But Ashish is asking for a little more understanding around your differentiating factors. His question is, can you help me understand what you're doing that is different from other companies that are offering enhanced Roth conversion strategies? Is it the relationship with the IRA lenders?
Mm-hmm. So the big thing is the IRA lending. I have, and if you can point me to some others out there doing what we're doing, I would love to see that. In my research, I have seen nobody put these pieces together in a way to have this sort of optimization. With the big hurdle in there being having the right IRA lending partners. So that would be our differentiation, is putting it all together so you don't have to try and navigate where to find a business appraiser, where to find an IRA lender, where to find a self-directed custodian, all these things.
You're a full service shop.
Yep, we want to make it. My benchmark is could my mother navigate this?
Yeah. Yep. All right. And last question, Manju. What are the SEC regulations concerning this strategy?
So this is under the same SEC regulations as any other business we're doing. Well, because we're going off our mailing list, which includes a pre-existing relationship, we'll be doing the 506 Bs, which means we can have in non-accredited investors. The conversion strategy does not actually touch the SEC's balloon of jurisdiction.
Okay. And with that, hey, everybody, can you take yourselves off of mute and thank Casey for coming in and speaking to us today?
Hey, thanks, Casey.
Thank you.
Absolutely.
Thanks so much, Casey.
Thanks,
Guys,
Casey.
Thanks for having me.
Thanks, Daniel.
Thank you, Casey.
Thank you. Thank you, Casey.
Thank you.
Could I
Thank
Could I ask
you.
for a quick survey? I'm just curious, great questions. We dug into it. How intriguing is this investment thesis to you guys? In the chat, if we could do like a, I don't know, 1
1
to
or 0.
10. Okay, 1 or 0. Yeah.
One
Let's
to
do 1
10
or
is fine.
0. Let's do one or 0. If this is something that you're interested in, would want to consider, put a 1 in. If it's like, not for me, 0.
The zeros aren't responding.
Batting 1,000 here. Yeah, the 0's left.
That could be. Could be.
Great.
All right. So there's definitely interest here. I think a lot of people. Dude, what is this? The IRS would say 0. All
Wonderful.
right. Yeah, I think this actually does hit our group pretty well, particularly since there's so many people that are kind of in a job transition right now with Intel. And so it's a timely topic and it's an interesting strategy. So thank you for coming here and speaking to us. And thank you for being part of the Alternative Investing Club.
Absolutely. Guys, great to meet you. Thanks for having me. I'm going to get back to the vacation now. But for everyone who said one, please sign up for our investor club just so you can keep up to speed as we finalize things and move towards launch. Would love to bring this to this group. And I don't think there's much of other way to connect moving forward if we don't get connected on the investor club. So,
Yep. Hey, Casey, I'd like to do a follow-up with you as well.
okay, excellent. Let's make it happen. All right.
All right. Cheers.
Thanks,
Have a
everyone.
wonderful weekend, everyone.